Yeah, I know it's a real estate show. We're not talking about real estate tax appeals. We're talking about your income taxes, your capital gains taxes, your estate taxes. How do we give the government less of our money?
What's the biggest mistake you see high net worth individuals, making when they try to preserve generational wealth or the tax mistakes, of high net worth?
Yeah, so the tax mistake is most often not paying attention to what options exist and relying exclusively on the advice of their tax preparing accountant. But there's a lot beyond that. And I think many, especially entrepreneurial real estate investors, they're not necessarily aware that they may need a tax strategist in their life.
Real estate investors are out there making millions and quietly bleeding hundreds of thousands, sometimes more, because they don't understand the game behind the game. While they obsess over deals and doors, the real power players are quietly rewriting their futures using the tax code like a blueprint for generational wealth. My guest today, he's not your accountant. He's the architect behind billion-dollar family legacies. And if you're not listening, you're leaving fortunes on the table.
Just because you mentioned, the likes of Donald Trump and Elon Musk, even Warren Buffett, they use a strategy, and hopefully all of your listeners are familiar with it. But if you're not, it is going to be key. It's called buy, borrow, die. For the last 25 years, I've been filing as a real estate professional. For the first 9 of those years, I had a full-time job as an accountant at an accounting firm. How many times has the IRS asked me to defend my real estate professional status? What do you think?
Probably zero.
Zero, exactly. And then I showed him a strategy where he could buy solar installation. And as a result, we were able to get him $1.5 million of credit in excess of what his equity check was. And he was able to put that back and apply it to the previous year and get his $1.5 million refund. So the IRS publishes a list every year of tax strategies they don't like. We come up with the creative ideas. We're a team of creatives, which is unique for technical areas. If your heart had a compass, where would it point? Prosperity equals wealth times happiness. You concentrate to create, you diversify to protect.
All right, folks, welcome back to Real Estate Profit Boost, where, we put a little bit more NOI into real estate. And today I have actually a very good friend of mine. And, he's got a bio that's, around 20 minutes long, including, 5 books, third generation CPA, 900 million in real estate transactions. But more importantly, he saves people a ton of money on taxes. And really that's, Noah's, well, they're all your forte, Noah. But welcome. It's Noah Rosenfarb from several businesses. But what's your main business today, Noah, and how people find you?
Wealththrive.com. So it's the combination of wealth and thrive, WealthThrive.com.
Okay, perfect. And that part of your businesses, that focuses on the tax part, correct?
Tax strategy. Yeah, I know it's a real estate show. We're not talking about real estate tax appeals. We're talking about your income taxes, your capital gains taxes, your estate taxes. How do we give the government less of our money?
There you go. I'm with you right there. Well, so our audience is anything from, a beginner, real estate investor all the way to an institutional syndicator with, 2,500 units across the United States. And there always comes a time where the beginner or the institution needs to start looking at taxes, right? And for example, for me, I own the insurance agency, but I also own real estate, right? And part of that is for taxes. So if your focus today is on helping entrepreneurs create what you call predictable income, build a legacy, what's the biggest mistake you see high net worth individuals, making when they try to preserve generational wealth or the tax mistakes, of high net worth?
So the tax mistake is most often not paying attention to what options exist and relying exclusively on the advice of their tax preparing accountant. And the accountants, typically have a rear view mirror mindset. They like to report information that's already taken place and put numbers in boxes. That's the job of a tax preparer, and proficient tax preparers may also talk to their clients about things that they could do before the end of the year to potentially limit their tax liability, or maybe they'll explain to you, 1031 transactions, some basic tax codes that you could leverage. But there's a lot beyond that. And I think many, especially entrepreneurial real estate investors, they're not necessarily aware that they may need a tax strategist in their life.
Right. No, I can, from my own experience, everything that we do in our business is with a strategic partner, right? So if I engage a CPA, I need them to be a real estate CPA, for example, because that's the bulk of our business. And you know how many times I've asked people to get me a real estate specialist CPA, or our clients are asking for a referral, and I don't have one. So what you said is they rely on their general tax preparer, and they're missing out on a lot of sophistication. Is that what I'm hearing?
Yeah, no doubt about it. And it's really, it's not a diminishment of the accountant's role in preparing your tax return. It's really a different business. And so just like you wouldn't necessarily go to your primary doctor when you're having a cardiology issue, you go to your cardiologist for your heart. And the same is true, when you're making $1 million a year or more, you don't want to just rely on your accountant to prepare your return. You want to go to a specialist that's going to help you broaden your horizons on what might be possible for your situation.
Understood. Okay, so so the audience can bite their teeth into something. What's one of the biggest mistakes you've seen by not going to a specialist like yourself when it comes to taxes?
So most people just prepare their returns with whatever their accountant recommends. And so, again, we're in the real estate business. I've been filing as a real estate professional for the last 25 years, despite having other businesses that I invest in and participate in. But that real estate professional status gives me certain tax benefits that come along with it. And maybe you have listeners that they're still at their W-2 job, they're still making a living, doing something, working for someone else, and they've got some rental property on the side. Well, at what point can they file as a real estate professional? And how might they try and classify things so that they could achieve that status, which might be really helpful? That's a big mistake we see. People don't really strategize on how to become a real estate professional, even though they're real estate investors. And that's a big overlooked one. I would say not availing themselves of Section 1031 and using the tax-free rollover. That is a benefit that most real estate investors are aware of. But when they don't want to use that, oftentimes they're just paying the tax. They're unaware that there are other strategies besides 1031 to either defer the tax or potentially even eliminate the tax.
Understood. And by the way, we do have another show on a 1031 specialist, so check that one out down below in the list. So thanks for bringing that up. So you mentioned if you can classify yourself as a professional real estate investor, right? So for example, I own about 144 units, multifamily, some retail, industrial, but my main cash machine is Premier Protection Insurance, right? So, I've been down this road with my accountant. So what are the benefits and what are the qualifications, right? I guess we start with benefits. If you can walk us down that path, that would be, I think, extremely helpful, even to me, obviously.
So when you generate real estate losses, so for tax purposes, despite having potentially cash flow from your real estate assets, you may be generating tax losses. And those tax losses are most often created through depreciation. And at acquisition, you're typically going to want to do a cost segregation study and generate accelerated depreciation and bonus depreciation to accelerate your write-offs and your losses. Well, if you're not a real estate professional, those real estate losses will only offset other real estate income. So if you had a sale of an asset and you bought a new asset and you took your depreciation losses are going to offset that other real estate gain. But let's take your position, Jerry. You own your insurance agency, and let's just say you're generating ordinary income from your agency. Well, if you're a real estate professional, those real estate losses will now offset your Premier Protection Insurance Agency profits. And that's the strategy that I've been using for the last 25 years. I generate my ordinary income from income producing businesses, and then I offset that income with depreciation from real estate losses. And that combination is really powerful.
Right. So okay, so I can't tell you how many real estate investors that own businesses I've spoke to, right? And they do, they accelerated depreciation, cost segregation, or those types of things. And they think if I own a fourplex or an eightplex and I have a business, or I'm a doctor and I'm making $1 million in my business, and that depreciation is going to come off my ordinary income from my business, my doctor's business, my insurance agency. That's what they all think, by the way. You know how many times I've talked to them? But what you're saying, for example, if I'm a professional insurance agent and I'm making $1 million a year and in the insurance business, doesn't matter the depreciation that I have in my buildings. I can only take those depreciation losses, let's call it, off of the income of the real estate.
Correct. 100% true. And
correct.
And that's a massively overlooked issue. And so you would ask, what are the requirements to qualify as a real estate professional? The IRS has a 5-prong test, but what I find is that really 2 of the prongs are the hardest to meet. And surprisingly, for most people, being a licensed realtor is not part of the test. It's unrelated. You do not need to be a licensed realtor. And if you are a licensed realtor, that does not qualify you. So the 2 hardest tests to pass are that it's 750 hours of effort or more, and it has to be more effort than anything else you do. So when you operate as an employee, if you're employed somewhere on a full-time basis, your hourly equivalent is essentially 2,000 hours a year that you're doing that. So that means in order to be a real estate professional, you have to do more than 2,000 hours a year of real estate work. That becomes very difficult to substantiate if you have, a fourplex and a 3,000 square foot retail space. It's just hard to say it took you 2,000 hours of management. So
interesting.
Go ahead, Jared.
No, so curious. For me, right, this affects me tremendously among many viewers here, I'm sure. So for example, I own real estate since 2000. I buy, sell, everything like that. I have a property manager that I trained. He's my mentee. But I am a W-2 employee because I'm a single member LLC of this entity here, where before I had a partner, I was not. I was working on distributions. So I get it. So 2,000 hours is a full annual work year, roughly. Right?
If you're full-time employed by the company. So just because you're a single member LLC doesn't mean you have to work full-time for the company. So in 2024, I received 3 W-2s, and I was a real estate professional. For the last 25 years, I've been filing as a real estate professional. For the first 9 of those years, I had a full-time job as an accountant at an accounting firm. But over the last 25 years, I'll give you one guess. How many times has the IRS asked me to defend my real estate professional status? What do you think?
Probably 0.
0, exactly. Yeah. They've never asked me to. Now, I have confidence.
Okay.
I have confidence if the IRS asked me to defend my real estate professional status, that I could defend it. And in the event that I'm wrong, and this is where audit risk comes into play, and most entrepreneurs don't.
I want to take a quick break to ask, did you enjoy the video so far? If you want to learn how real estate titans make millions, hit that subscribe button now. Join us on Real Estate Profit Boost with Jerry Katz at Jerry Katz CEO for expert tips and insider strategies to grow your wealth.
Don't have the education to understand, well, what if the IRS disagrees with me? Well, what are the consequences? So there's 3 things that the IRS could do when they disagree with you as a taxpayer. So the worst case scenario is they disallow everything. Sorry, Jerry, you are not a real estate professional despite basically spending all of your time in real estate. It's because you have this W-2 from Premier. Well, let's say you lose that case, 100%. So what they're going to do is they're going to say, okay, Jerry, we want you to pay the tax that you would have paid had you reported yourself as not a real estate professional anyway. Well, that didn't really cost you anything because that's the way you were reporting it last year, right?
Understood. Right. So when they do a full audit, they don't target the entire spectrum of my finances and all my entities. It's targeted just to the real estate.
It's targeted to whatever they request. So typically when you're audited, they're going to ask you to defend either 1, 2, or 3 line items on your tax return. And then when you present them with your evidence, that may widen the scope because they may say, oh, we don't like any of your answers. We want to see everything. Or it may narrow the scope. They may say, oh, you know what? We like this. I just had an audit. I have a business in Puerto Rico. We were just audited. They asked me for my lease. I sent them my lease. Audit was closed. That was it.
Wow. That was it. Very
But going
interesting.
back to this real estate professional status, and let's just say you were wrong. So the IRS disagreed with you. You're paying them the tax that you would have paid them had you not filed as a real estate professional. So again, not really a cost there.
Right.
The second thing they'll do is charge you interest on the amount of money that you should have paid from when you should have paid it till now. So again, we're all real estate professionals. Hopefully we're out earning what the IRS charges. They're not a hard money lender. They're usually charging 6%, 7%, 8%. Pretty much think of it as like a 30-year mortgage rate. That's what the government's going to charge. And then the third thing that they could do is the punitive piece, which is charge you a penalty. But on a status dispute like this, if you have a reasonable defense, like you would, Jerry,
Right.
you can ask for a penalty waiver. And if you haven't asked the IRS to waive your penalty in any of the last 3 tax years, in almost all cases where it's a reasonable disagreement with them, they'll waive the penalty. So, I kind of operate from the perspective that it's better to ask for forgiveness than permission. And one of the rules about our tax system is that it's self-reporting. So we get to decide how to report our tax information. And it's only when the IRS asks us to defend ourselves that we then have to show them how we came up with our answer.
Understood. What are the percentages of your clients that claim the real estate professional, right, that get audited? Is it 5%?
I have not
Is it
yet
20%?
had an individual client get audited on their real estate professional status designation.
Right. I mean, for me, for example, I'm the host of the Real Estate Profit Boost show, right?
Exactly.
But,
Right.
I mean, listen, I just want to be clear to everybody how powerful this is. If you have a business and you own real estate, so for an example, if I make $1 million here in Premier Protection a year, right, net, right, after all my expenses, I am going to pay ordinary income plus state tax plus city tax, depending on the geographic area. If you live in California, it's over 50%, folks. So if I can claim real estate professional status with the IRS, I could immediately buy, for example, $1 million piece of property with a mortgage with only 20% down, do an accelerated depreciation, which is technically a loss. And let's say that accelerated depreciation gives me, through cost segregation, a $400,000 deduction or depreciation or a loss. So immediately, $1 million minus $400,000, I'm paying on $600,000.
Exactly.
That is huge, right?
Yeah, it's huge.
Huge, right?
Now-
And so it's critical. And go ahead. What I like about Noah, right, is I'm from the outside, right? I'm not a CPA, 3 generations. I don't run a family office. I don't have all these crazy tax strategies. This is Noah's business. So if you're a mechanic, right, and cars break down, for you it's a non-event. For us, we're in the insurance business. We deal with hurricanes, non-event. That could be a seriously, scary thing for Noah. But if you look at how his attitude it is with the IRS, and he knows his risks, he knows his risk tolerances, that to me is an aha, right? Because you basically explained, is it worth it to just try this? If not, here's the worst case scenario where people out here, we're in a panic attack when we hear the word audit, right? So to me, your whole demeanor around it, puts a light bulb into my head, Is that one of your largest challenges to saving people money in tax strategies, is to get the client's head around alternative strategies and avoid audits?
Yeah, most people, the way they ask the question is they say, is this legal? When we describe something that they may undertake. And the answer to that is, well, we believe it's legal, but if the IRS were to scrutinize this and we defended ourselves, we may still enter into a disagreement with the IRS. So I have a client, in 2018, they participated in a conservation easement transaction. And that's a real estate transaction. Essentially what we partnered with an operator of a local minerals mine where they would dig up the earth and mine the minerals out of the clay. And down the street, they had purchased a parcel, which my client invested in, and they agreed to conserve the minerals. So they were not going to dig up the dirt. Now, we knew at the time that particular strategy was on what's called the Dirty Dozen list. So the IRS publishes a list every year of tax strategies they don't like. Doesn't mean they're illegal, doesn't mean you can't do them. It's just the IRS, they call it a warning to taxpayers for the worst of the worst tax scams. That's how they call it. I call it the list of things they don't want you to do because maybe it's too good for you.
Right.
So in this particular case,
that's completely illegal, right? Because otherwise
Right.
the Dirty Dozen wouldn't exist. It's their tax loop that they
Right.
say, you try to pull this, we made it legal, but be ready, right?
Be ready.
Validate.
So we went into this transaction knowing that the client would be audited. Now, that was 2018. He saved $4 million in tax. Fast forward to 2025, it's 7 years later. The $4 million is now worth about 10. The audit is still pending. Now, in all likelihood, that audit will get settled. So just like a business dispute, when you have a dispute with the IRS, you can either litigate to a conclusion, which means a judge is going to make a decision, or you can negotiate a resolution, and the IRS and the taxpayer will agree on a settlement. Now, in most cases where there's a dispute between the taxpayer and the IRS, they're often willing to negotiate resolution of about 20% of the tax because that gets them underneath a penalty requirement. And so in my client's case, maybe he'll pay them back $1 million. Well, he's up ahead $9 million. So
Right.
it was worth it, right? And so, was that legal? Was it not legal? Well, it's a strategy to take advantage of the tax code, recognizing that the IRS may come in and have a disagreement with the taxpayer and understanding what the consequences, what's the worst consequence of that disagreement. In his particular case, Lloyd's of London underwrote that deal, and they guaranteed him as the taxpayer that he wouldn't lose more than 3 cents on the dollar. So that was his maximum exposure in that structure.
Okay, so there was an insurance policy put into place, right?
Yeah,
On
and
that.
there was
Okay.
audit defense insurance of $1.5 million, so that we knew the structure would be able to provide defense of itself. So we evaluate these risks with our eyes wide open. We describe them to the taxpayer because
Right.
you have to know what it is you're doing. And most of our clients are entrepreneurs. They've taken risks all their life. And what we often find is that when they ask their accountant's risk tolerance is vastly different than theirs. And so what we want to help them do is assess, is their accountant's advice coming from a place of knowledge and experience, or is it coming from a place of fear and anxiety?
I love it. Right.
Yeah.
That's so important, what you just said, right? So we have a process called TAO in the insurance industry, or in our agency, total asset optimization. Once we gather their entire real estate portfolio, see where they own it, how long they've owned it, their debt structures, cost basis, depreciation, right? The first conversation is risk tolerance. Okay? So just like you said, that's the magic word. So I have clients, right, which one of them, who's got
No
around
wind,
12
no wind. Who
Yeah,
needs
no
wind? Yeah.
So this is a gentleman who's sitting on $100+ million portfolio, centrally located in one area in a hurricane state, and he has no wind, zero wind. Now, when I talk to other clients, right? So we have a client that had a 122-unit hotel in Lake of the Ozarks. 2 years after he bought it, he took a tornado, right? And it went right in it. So obviously, he's still got PTSD, and his insurance expenses are 5x of what the other gentleman's is. So it's very interesting that you brought that up, because most people don't look at that psychological aspect, right? Because with an audit, for example, how many family offices do you represent, or they're your clients, who basically have you, let's say, on retainer? They don't function without Noah Rosenfarb, correct?
Yeah, well, because they want to know what are my options, right? It's not just here's your tax return, the numbers are done. It's planning before things ever happen to understand, okay, I'm selling this building. I've got, a $20 million asset. I have 10 million of debt. There's 10 million of equity sitting there. What am I going to do now? Do I want to roll it over? I'm 78 years old. I really don't want, am I going to roll it into a Walgreens and clip a 4.5% coupon? Like, does that make sense? And then I'll get a step up in basis when I die. Is that rule even going to be there? So we try and play out all the various scenarios for the client to figure out what is optimal. Maybe it's entering into another structure besides 1031, besides, just converting into cash and paying 100% of the capital gains tax. And maybe if it's helpful, I could kind of give you one of those strategies just so people could have it in their mind.
No, of course. But in the meantime, listen, I want the audience to say, number one, this is extremely valuable information. You're dealing with an extremely sophisticated person who's been through a third generations of this. And these are the secrets of the rich and famous, right? And the family offices, even our president, Donald Trump, right? I know we may like him, we may not like him. And Elon Musk, they don't operate at a high level, right? With real estate businesses without a guy like Noah on their team permanently, right? Because they're dealing with this every day. And for them, the IRS, external revenue service, internal revenue service, it's common day, just like an auto mechanic is working on a car and so on. So first of all, comment, like, subscribe, and share with friends. You could always reach out to Noah at wealththrive.com, and you'll have all the links down below, including your dirty dozen, I'm sure. So yes, Now please do that for us, what you were about to say.
One thing I'll share, just because you mentioned, the likes of Donald Trump and Elon Musk, even Warren Buffett, they use a strategy, and hopefully all of your listeners are familiar with it, but if you're not, it is going to be key. It's called buy, borrow, die.
And that's what I'm talking about. Listen to that value. Listen to those strategies. Listen to those secrets. Now, if you like what you hear right now, I need you to like, I need you to subscribe, and I need you to share with a friend, that's right, who wants to scale in real estate. And even more importantly, maybe you heard something that we didn't. So put a comment below and share your insights on this video, because you know what? That's what this channel is about. Learning and growing from each other, and you may see something that we don't. So this is Real Estate Profit Boost, where people learn how to scale in the world of commercial real estate.
And the idea is that you buy your assets, you borrow against your assets. And so when you buy that, you kind of have that $6 million asset with $4 million in debt. It appreciates to 10 million. You refinance, you take out 7 million, you pay off your $4 million first, and you get 3 million in cash. Zero taxes, because you're allowed to borrow against your asset again, so long as you have basis subject to certain rules, but you won't pay any tax on the money you're borrowing out. And you can do that time and time again. And eventually, if you die owning that asset, assuming the rules don't change, your heirs can sell that piece of real estate after you die and pay no capital gains tax. Now, it may still be subject to estate tax, but it won't be subject to capital gains tax. So buy, borrow, die is an amazing strategy for long-term investors that want to preserve intergenerational family wealth. But some families have other goals. And again, what we try and do is match up what are your goals? What's your long-term investment strategy? What are you trying to do between generations? What are you trying to do for your cash flow? And then tie all of that together with a wise tax strategy.
On the buy, borrow, die, you made a small comment about your heirs do not pay the capital gains if they sell it. It doesn't.
Correct.
No.
Yeah. Once you die, you have essentially 9 months to file your estate tax return. The value of the asset at the date of death becomes the basis for the estate. And that's true whether you own Apple stock or Tesla stock or the bank on the corner. no matter what asset you have, you get what's referred to as a step up in basis at death. Those are the current estate tax rules. The current estate tax rules allow for a $13 million gift per person in 2025. That number is going to go down to about $7 million per person in 2026, absent any new legislation from the Trump administration. The word on the street is they don't plan to spend their political capital to change that law, so they're going to let the amount go down. But they will continue to have that step up in basis. And presumably that step up in basis will continue unless we have significant estate tax law changes. So we rely on the step up in basis in our planning, even for people that are in their 70s or 80s, where the assumption is they may not die during this administration. Hopefully they're going to live through multiple administrations, but we want to rely on that step up.
I mean, that's huge, right? Like, and a light bulb just went off in my head. So I don't think most people understand this, right? Meaning that, let's say, like, for example, my first Fourplex I bought 34 years ago. I paid $80,000 for it. Today, it's worth $2 million. That's just one of my properties, right? Because we live in Miami and so forth. So the point is, I've cashed out, refied that property 5 times, and my rents continue to increase. When I bought it, rents were $400 a unit. Today, they're $2,200 a unit. So I've never paid tax on, the debt that I've taken out, but I always assumed, God forbid I pass away, that my kids will have, because if I sell it today, okay, I'm paying, it's all depreciated. It's almost $2 million. Let's say I sell it for $2 million. It's almost, that's the whole, capital gain.
$2 million gain, right? 400K of taxes.
So upon my death, which we don't want, but whatever, you're telling me that's the immediate step up in basis for my kids and my estate. Huge.
Yeah.
So now I know. I'll tell you, one of the biggest mistakes that I made, right, is I came down to Florida from New York in 2000. I started buying multifamily real estate, my background. And I got my butt handed to me in Wall Street, right? Before 30, made a few $1 million. The dot-com bubble wiped me out. I had a negative 60 margin call. I lost it all. So I believed in these cycles, right? Interest rate cycles, bubble cycles. So I moved to Florida. Long story short, with credit cards and things like that, I built up $30,000 in equity, and I exited in 2007 with 2 other partners for around a $32 million gross number. But I had, $4 million in equity. And I thought I was a genius, okay? Because the market crashed in '08, because we saw all the signs. Now I look back, right? And I say to myself, my God, if I owned that property today, it would be $125 million, right? And what I've learned is I didn't do the right thing trying to time the cycle. So that's exactly what you said, right? Because even the step up basis. So do you have any lessons like that, or?
Yeah, I would say we often see elderly real estate owners. So, people in their 80s, 90s, where they're kind of done with the operations of real estate. They may have infrastructure, they may not, but they kind of want out of the headache, and they're thinking of selling. And the reality is they shouldn't be selling the real estate. What they should be doing is like a master lease structure, and basically guaranteeing that the person who enters into the transaction with them for the master lease, they're going to get all the upside, they're going to get all the cash flow, but it'll enable that individual to get a step up in basis when they die, so they don't have to pay all the capital gains tax. That's one strategy I've seen work well.
It's funny. You're absolutely right. So my property manager brought me a 22 unit in Boynton Beach. An 86-year-old wants out. He's owned it since 1970. And he's just said, I'm going to pay the capital gains tax. So explain what he should do, because he is a client of ours and he's on this audience. So if you were engaging with WealthThrive and Noah Rosenfarb, how would you advise him?
Yeah, it depends on all of his goals and what he needs liquidity for. But typically you can structure around that, especially, at 86, it's interesting because you may have, from an actuarial standpoint, if you don't have a disease that's known to cut your life short, you probably have about a 7 or 8 year life expectancy. Even, because you're of how we age.
Debt also, by the way. 0
right.
debt. Yeah.
So often what you can do is that seller typically doesn't need the cash at closing for anything in their life. What they want to get rid of is a headache. And what they want is cash flow more than a lump sum of cash, unless they need it to distribute to their kids for some reason. But so often what you could do is enter into an agreement where you'll provide them with what would amount to the seller financing arrangement, and you're going to pay them the cash flow that they would otherwise receive from that building for as long as they're alive, and the lump sum wouldn't get paid until death. And that way, the buyer's able to increase the value. The buyer doesn't have to obtain debt to close on the purchase. The buyer can improve the property and benefit from the increase in value. And then at death, the transaction takes place on the date of death for the current value. Let's say it's a $2 million property. They're going to sell it for $2 million in 5 years, 7 years, 8 years from now. But they've been paying the cash flow all along. It's almost like their option price.
So how would you... Understood. So that's structured. So when you're making an offer on a piece of real estate in that situation as the buyer, how do you structure the contract? As a master lease?
It's an option, a master lease with an option to buy. Yeah.
With an option to buy. So there is, and the title of the property stays in the original owner's name.
Stays in the original owner's name. Yeah, you may make capital improvements to the property. You may put mortgages against the property as you're investing those capital improvements in case for some reason, there's any kind of litigation, you want to protect your interest. I would say the hardest part of these transactions is getting the seller comfortable. So usually we see this with intergenerational transactions or family-related party transactions where maybe you've got two brothers that grew up in real estate together, and now they're going to transition to their kids, but the first cousins don't want to own the same assets together. They kind of want to separate into two different family business assets. So how do you buy Uncle Bob out? This is a way to buy him out by still enabling the step up in basis.
Understood. Yeah, so it's interesting. We had a client who's based out of New Jersey, and they had a 900-unit portfolio in Jacksonville. And we're dealing with somebody named ABC, but all the insurance policies are in the name of XYZ, right? And these are personal names. They weren't even LLCs because the portfolio was purchased 50 years ago. I don't know why. So when we had to do all the insurance, I noticed, I go, wait a minute. The property appraiser's office say, this is the owner. And then he's like, no. And he said to me, it's a master lease for 30 years. And I said, it's a 30-year master lease. He goes, yeah. And at the end of the 30 years, it gets turned over for $1 to us. So owner financed. So right. Very, very interesting. And the seller never paid capital gains. He got his chunk deposit. He asked for 30% down on the price. So Are you able to structure deals like that? Do you have an attorney that also works in-house, right? Because if you don't do it the right way, I'm sure it's a problem, right? Especially with the IRS, or maybe not.
Yeah, well, I've assembled a team of attorneys, accountants, and financial planners that work together to help high-income taxpayers, achieve what we like to call a life that's rich beyond money. So we're focused on taxes, but we're also making sure that they could achieve their personal goals and their financial goals and their business goals. So we don't actually do the drafting, we do the strategy. So we'll help come up, like today I was on a call with some owners trying to, scheme out how do we, structure a deferred compensation plan. We're the idea people. We come up with the creative ideas. We're a team of creatives, which is unique for technical areas, but that's the team we've assembled, are people that have an entrepreneurial mindset, that love to support entrepreneurs through creative ideas, and recognize that there's a risk reward in everything that we do, not just the business decisions we make on whether we're going to invest in launching a podcast, or whether we're going to invest in digital marketing, or whether we're going to get, upgrade from this one platform to another. But we should make those same risk adjusted decisions when it comes to our tax strategy and when it comes to our investments.
Got it. So you mentioned that rich beyond money, right, is the tagline. What's the definition of beyond money?
I think it differs for everyone. What I've found is that it really comprises three components. The first is having financial success, financial independence, financial freedom. For most people, that's defined by having passive income that exceeds your monthly needs. Then you've got, total financial freedom if you could rely on that. The second is making sure that your time is being spent with the people in the ways that you want it. And the best way to answer this question to see if you're there or not, I like to do a short exercise. You go buy a lottery ticket and you think, okay, if I won this lottery, I get $200 million wire tomorrow, who would I spend more time with and who would I spend less time with? And what are the things I'd start doing and what are the things I'd stop doing? And then when you look at your answers to those questions, you have to ask yourself, do I need to win the lottery to do this? Or do I just need more courage, more planning, more thoughtfulness? And I think when you could identify the answers to those questions and say, you know what, I'm doing everything the way I want to be doing it, that's part of becoming rich beyond money. And then the third piece is where you still find that you have meaning and purpose in your life. Too many entrepreneurs that I've worked with, I've got a couple of books behind me, one called Exit Healthy, Wealthy, and Wise, the other Exit Rich Beyond Money. And so I've worked with a lot of entrepreneurs.
You signed them both for me back here. Yep. Yeah. Got them too. Go ahead.
I've worked with a lot of entrepreneurs that sell their businesses. And one of the things that happens is they achieve that financial independence. Now they're going to have passive monthly income coming from their portfolio of investments. They're going to have a clean slate calendar. They could do whatever they want with their time. But what becomes missing for them, and the reason 75% of entrepreneurs that sell their companies report a diminished level of happiness, really relates to the loss of meaning and purpose. And they found a lot of meaning and purpose in the work that they were doing and the people that they interacted with. And when they sell their company, it's like a piece of their heart goes away. And so one of the things that we believe that entrepreneurs, real estate investors, that you need to focus on is, even if you have the money, even if you have the time, you still have to find a way to contribute to others that makes you feel good about yourself and the value of who you are as an individual. Huge. And there's three places that we see repeatedly people get that satisfaction. One is probably pretty obvious. People spend more time with their family. They become a more active grandparent than they were a parent. They become a more active mentor to their children. They become more active, just in building those family bonds. Maybe it was a matriarchal family where their spouse was really the spearhead of the family and organization. But now, as a patriarch, without the business that they have to run, they get more engaged in running their family. Another area which has been really true for me is sharing my experience, coming on podcasts like this, teaching to YPO, EO, Tiger 21, Vistage. Sharing what I've learned has really been incredibly rewarding for me. Hearing people, I got a text the other day after I had given a talk, and the guy said, I just booked out my Wednesdays to spend with my wife. That's one of the things I did with my time when I turned 40, is I started spending Wednesdays with my wife. Been a game changer for our relationship. And then the third piece is supporting noble causes and being engaged in the causes that you care about and contributing to them, whether with time or money or both. But I would say, that rich beyond money philosophy really incorporates all those areas.
So when you engage in a client, or a client engages in you, do you have a process for this? You're basically saying, okay, hey, you're about to exit your business and make $100 million, $50 million, right? We've experienced, these signs of depression or not having enough energy or boredom. So you have a process to take your clients through this?
Yeah, we actually do.
Okay.
Yeah, and we call it our True North process. And we basically say, if your heart had a compass, where would it point?
I want to take a quick break to ask, did you enjoy the video so far? If you want to learn how real estate titans make millions, hit that subscribe button now. Join us on Real Estate Profit Boost with Jerry Katz at Jerry Katz EO for expert tips and insider strategies to grow your wealth.
And so what we do, our first call, our initial call with new clients are typically for married couples with the husband and the wife, unlike many of the other professional meetings that they might have where only one spouse is involved. And we have a visioning exercise, and we talk about that next chapter of life. For people with kids in the house, it might be when the kids get out of the house. And for the people that are, kids are out of the house, but they're still running a business, it might be when they sell their business. But when you turn to that next chapter of your life, what's that going to look like? How are you going to spend your time, and who are you going to spend it with, and how much cash flow do you think you need, and where do you want to spend it? Are you going to be traveling all over the world? Are you flying first class? Do you have your own private jet? And so we try and shape out, what is the life that you're trying to create? what does that really look like? How much income might you need to support it? How much time might you need, time freedom to accomplish those objectives? And then we start backing into, how do we bring that into today? We have a perfect week exercise where we look at, how do you take that future that you want and start sprinkling it in now so you don't have to wait 10 years? How do you have that today? How do you start getting more of what you want in your life now? And if we can free up some of your cash flow by paying less in taxes, well, that's a great way to accelerate your financial success.
Interesting, right? So we deal with a lot of entrepreneurs, you and I are an EO, and all this good stuff. How open-minded are these older generations, right? Because, like Trump, he's going to work till the day he, goes, I would say, right? How open-minded are they to going down, the vision of the perfect week, right? I mean, do you get resistance, or do you find this is why, not only for your tax strategies and all the other benefits you offer, but are they engaging you for that? Because, listen, how many third-generation CPAs, family office, fund owners like yourself would actually even offer this service? I think you're the first.
Yeah, well, that's, I tried to build what I needed for me. I sold my last operating business in 2014, was essentially retired, just investing in businesses and real estate. And I realized what was missing for me. And then I started speaking about it in the entrepreneurial community. And people were saying, can you help me? Can you help me? And I was like, I don't want a job. But eventually the call became too strong and I assembled this team. And so I still get an opportunity to do what I want. I work about 800 hours a year, 20 hours a week, 40 weeks a year in and on my business. And then the rest of the time, I'm doing the things that I was otherwise doing when I didn't have an operating business. And what I've found is that blend for me, I think can carry me through, hopefully, until I can't do it anymore. And this at this cadence, there's no reason to stop. And I think one of the things we work with a lot of entrepreneurs on is how can you get your business in a position where you wouldn't want to sell it? Because ultimately, your best cash flow is going to come from your company. There's no better investment than the business you've created. You're not going to find another investment that you're going to dedicate as much of a percentage of your wealth to, because when you sell that business, you're not going to go and take 80% of those proceeds and go put it into one single company again. It's just not going to happen. But
right?
if you love the one you're with, right? If you know what you have, and what do they say? The devil you know is better than the devil you don't know. So if you know the risks in your business, if you know the team that's running it, if you've built it in such a way that it gives you what you want out of your life, well, maybe there's no reason to sell it and get 6, 7, 8, 9, 10 times cash flow when you're going to take those proceeds, and then what? Then you're going to have to find other investments that are going to generate a similar return. It's kind of hard.
Now, listen, you're challenging a lot of the status quos, right? Even my own mindset. When I read the Vern Harnish books, Start, Scale, Exit, Repeat, our friend Colin Campbell, every entrepreneur hears the word, what's your exit strategy, right? So he just said, what if we could find a way for you not to sell your business? Because you're right. For me to duplicate this business, very difficult. But I think about a sale one day as the goal, right? But again, I know from my experience that most entrepreneurs who sell, even the ones that get, let's call it work hard, not lucky. I was going to say lucky, but it's not lucky, that sell at 35 years old, a $25 million software company, right? What I've seen in my experience is I'd say 75 to 85% of them fail in their next businesses because of what you said, right? Because they know their business, they know how to do it. So what type of strategy would get me not to sell this business, I guess? Or why is the mindset of entrepreneurs, why are we taught that the exit is the gold medal? Interesting. Very interesting, Noah.
It's just a cultural thing. People want to celebrate the sale of a company as the peak. And what I see as really the peak is being an owner in your 70s and traveling around the world and contributing and mentoring your team and still getting the cash flow from that business you've created, while it still enables you to have that meaning and purpose that you want to maintain. in contributing value to the world. And again, for those of us that are real estate entrepreneurs, we may be expressing ourselves through the development of properties. We may be expressing ourselves through the redevelopment of properties. We may just be in a position where we want long-term legacy assets that produce cash flow that could support future generations. Well, sometimes I look at it as people that are selling the goose that lays the golden eggs. And, it's hard to get back
Great
to
metaphor.
that status, right? And so it's really finding, from a business operations standpoint, how do you ensure that your time in the business is where you're contributing in your highest and best use, what Dan Sullivan would call what's Dan Sullivan's phraseology for it? Your unique ability, right?
Right.
Where you're in my business, I'm content and I'm visionary, right? I'm big ideas, product innovation. How do I go out and source new tax strategies? How do we come up with new ideas to attract and retain business? But I don't do any individual client work because that's too time consuming. When a client needs you, you got to answer their call. Well, I'm going to be traveling all next year, So I want to have the life that I want and for my business to support me in achieving my life goals rather than the other way around.
So you mentioned you're going to travel all next year, right? But yet your business will be fully operational, and maybe even, are you worried if you're going to travel next year? Tell me the structure and how do you keep the anxiety? Because I think about it, right? Like, hey, let me grab my wife, kids, take off for 6 months, but anxiety, right? If I'm the operator, I always, we were taught, what is it? I set the pace, right?
Yes.
At my office, right? And when I disappear, the pace drops 30%. So tell me what systems, processes, what have you designed? Because I know you've taken multiple trips and been gone for a long time, but tell us about this up and coming trip, as well as everything I mentioned to keep your
So I'm real
anxiety.
excited. My son will be a freshman in college. He's not much for traveling, although he's been to 20-ish countries. But our daughter loves traveling, and so we're going to go through Europe in the fall and Asia in the spring, and she's going to spend her freshman year of high school as an online student. And I think that when you talk about the systems and processes, there's probably two components that are most important for me. One is, if my business crashed and burned and I made $0, I still have my financial independence. And that's, a sense of financial security that gives me confidence that, with or without it, I'm fine. Now, I'd prefer to be with it. That's the reason I created the business.
That's because you've been investing in many different types of investments, and your entire net worth is tied up in your business, right?
Correct.
So
I've been able to take enough out and have exits over the years and save enough where my passive income can cover my lifestyle. And now I just have this additional active income, which is great. My core investment philosophy and passive income philosophy has always been, by the time I got to 40, I wanted to be in a position where I would just spend my passive income. And all my active income would basically just enhance the passive income I'd be able to spend in the next year. So if I had $30,000 a month of passive income, my budget was $30,000 a month. If I made $500,000, hopefully that's going to create another 20, 30, 40 grand worth of additional passive income in next year. And now instead of spending 360, I could spend 400. And so that's how I stair step my lifestyle so that I know if everything, if all my active income stops, I don't have to tell my wife, sorry, we can't go 5 business class anymore. Sorry, we got to stay home.
Right. No, 100%. Okay. So before we get into the travel, so that's very interesting, right? So you, some point in your life, 20 years ago, 10 years ago, whatever it is, decided that, if to create that passive income, reverse engineer that for someone out here who's in their 30s or 40s, right? How they got to that point. Did you take 10% of your, income and invest it where? How? What was the strategy? How long did it take? Reverse engineer, because very valuable.
I'm a frugal good saver, and my wife is a frugal good saver too. So I'll start with the premise that, we never spent money on things that we didn't care significantly about. We've always liked experiences and travel, not as much material possessions. And so that has always been able to moderate our budget because, when we went to the Galapagos when we were 25 years old, we stayed in the belly of the beast and we were next to the engine room in bunk beds, but we were there. That was what was important to us, right? When we took our kids, we were in a beautiful ship with, 5-star catering. And so life changes. But what we did was we tried when we got married. My wife and I had the good fortune of meeting when we were teenagers. We got married out of college. We bought our first investment property when I was 23. We lived in half and we rented half, a 2-family house. Cute story about getting $40 at the closing table, no money down back then. I house hacked my first deal. And we wanted to build a portfolio of income producing real estate. And so that was back at the turn of the century, back in 2000. We bought our first home, and then we would every year or two try and go out and buy another 2-family house, 3-family house, and just start creating that passive income stream. Originally, the plan was don't spend my wife Amanda's salary. She was a school teacher, so we were saving her $30,000, $35,000, $40,000. And the deal was that way when we had kids and she wanted to become a stay-at-home mom, it's not like that was going to impact our lifestyle. We'd already been saving her income. And then on my income, I was maximizing my 401k plan. I was saving 10% of my net income and more if we could. And so by the time that we had our first kid, I was making, that year I was going to make $185,000 as a partner in an accounting firm. I was probably only spending half of that on our lifestyle, and the rest was just accumulating in savings. So
listen, by no means do you live a pauper's lifestyle. I know your house; it's multi-million dollars. Even I know Noah from 10 years ago or more. It's just you. I get it. You didn't make your $180,000 and buy 3 Lamborghinis and do all that stuff that you see on all the other channels.
exactly.
Right, because it's gone really quick. So the money you save from your wife's salary and income went into real estate, but multiple. So your
Yeah.
passive income is not just real estate, correct?
So we invested in real estate, we invested in the stock market, we invested in insurance, permanent insurance, we invested in businesses, we invested in hard money loans and private debt. I have a pretty diversified balance sheet, and so my income is coming from multiple sources: private businesses, public companies, private debt, public debt, private real estate, not so much public real estate, but lots of private real estate. And what I've found over time is that if I could just spend what I was making from my savings, again, that gave me this economic flywheel where every year I could increase my spending, but I could do it forever. That was really my mindset. I wanted it, when I turned 40, I wanted to know that I could never work a day in my life and only spend my passive income and have a lifestyle that I was happy with. And thankfully, over the last 8.5 years, I'll be 49 in May, I've been able to accelerate my expenses and, buy a yacht and fly business class and travel 6 weeks in the summer in Europe and, do all these things that are expensive, but knowing that I could do it forever and I didn't have to work for it. I already did the work.
Understood. So an interesting question. So once you had enough passive income to have a great lifestyle, right? Take care of the kids, wife, the whole thing, and for the future, because I know you're thinking about retirement and trusts and all that stuff. Then you were almost ready to switch over to what you said, right? Your vision beyond wealth, right? Beyond money, is the words. So you turn to more purpose-driven businesses, right? I know
Correct.
you work a lot with nonprofit. I know you run the Entrepreneurs Organization's Real Estate Deal Exchange, and most of that is voluntary. And even with the new business, right, Wealth Thrive, they're more purpose-driven. My question is, I have a feeling I know the answer. I bet you make more money today when you're in the purpose side. You follow where I'm going
it's true.
with this question?
Yeah, no, my active income's never been higher, right? And I think part of that is when I stripped away the need to make the money, it really just became driven by my heart. And in my heart, what I've come to realize is that I love entrepreneurs. I believe that entrepreneurs are heroes, that without us, the world's not going to turn around. And so we're the ones that have to create value. We're the ones that have to create jobs. We're the ones that have to innovate. And so I want to support entrepreneurs in achieving the lifestyle and the desires that they have, because the better we get at making sure that the entrepreneurs are treated like heroes, I think the better the world's going to be. And so that's really what drives me now. And, for me, it's a virtuous cycle, because my wife and I, as you mentioned, we're philanthropic and we've had a family foundation for a decade. And what I'm hoping is that the more financial success we have, the more that actually ends up translating to helping other people that don't have the same capacity, that weren't born in the same family, that didn't have a good brain, that didn't have the same motivation that I had, that didn't have the same drive to create a financial outcome. And I want to, teach them how to fish. I want to support the ones that, can't hold the pole, and make sure that they're well fed. And, I think it's just a part of our philosophy.
And that's what I'm talking about. Listen to that value. Listen to those strategies. Listen to those secrets. Now, if you like what you hear right now, I need you to like, I need you to subscribe, and I need you to share with a friend, that's right, who wants to scale in real estate. And even more importantly, maybe you heard something that we didn't. So put a comment below and share your insights on this video, because you know what? That's what this channel is about. Learning and growing from each other, and you may see something that we don't. So this is Real Estate Profit Boost, where people learn how to scale in the world of commercial real estate.
I think it's just a part of our philosophy.
Right. And the best thing is, and a lot of people don't know these things, right? So like when I'm on my Instagram channels or I'm speaking, what I find out is like the masses, they think like entrepreneurs or wealthy people. They think they're going after money. They think the purpose of a business is to make millions and money and money, money, money. And then when I speak, I come out and I talk about what you do, right? Values, purpose, helping, right? For me, what's the purpose of a business? It's to help people. And if you help people like you do, for example, in this tax and life, beyond, money, what happens is it's like you fix a problem proportionally to the amount of money that comes back to you, right? And the larger the problem that you fix, you're getting paid in proportion, regardless, even if you ask for the money. Right? That's what happens.
I was doing nonprofit work for a couple of years as my exclusive kind of contribution to my work effort. And I wasn't feeling as validated or meaningful or purposeful in that work. And that's when I kind of had to look around and answer the call of these entrepreneurs that were asking for my help. Because I was thinking, I can't do it for free. Like, that doesn't make sense. I'm not going to not charge them, because I'm going to create so much value for them. But what if I charge them and then I could give away that money? Well, that really becomes a powerful way to contribute to the world, more powerful than, sitting at United Way's boardroom and trying to help them figure out how to solve the homeless problem in downtown Fort Lauderdale.
Right. I've been there. And it's not easy. No, it's interesting, and I love it. And, people who watch Real Estate, Profit Boost, you'll hear me say all the time, values create win-win situations, have a purpose, be driven. And, I lost all my money when all I did was focus on money. And when I was growing up, I had that sign in my room that said, the one with all the toys wins, right?
With all the cars?
Yes, with
love
the
that
cars, the jet. Yeah, Gordon Gecko, whatever you want to call. Guess what? Nobody liked me, and I lost everything, right? When I went down there. But thank God I got a mentor that taught me about multifamily, real estate, and I felt so much better, right? Serving a purpose, buying turkeys for the Caribbean people that lived in my thing on Thanksgiving. So everything, started to shift. So big takeaway. So going back a little bit to real estate, right? So you're a guy who's participated in over 100 real estate transactions, or let's call it $900 million in real estate and things like that. So I know you have a really good eye on the market, right? So what's a current real estate trend that excites you, or one where you believe is worth investing in the future? Just to get a little bit back to real estate here.
Yeah, so
I've got some good insights.
I'm pretty much accumulating cash at this point. I'm waiting. We're sitting here in March of 2025. I think the, peak to trough in the asset class that I've been mostly focused on, which is like C class value add multifamily, peak to trough prices are down 30-ish%. I still think there might be a little bit of a ways to go. I believe that the lowering of interest rates, which we hope to see, continue throughout 2025, I don't think it's going to have a price impact on the lower end multifamily assets as much as we might all be hoping for, because I don't know where the demand is going to come from. I don't know when the purse strings are going to open up. Raising capital right now seems to be incredibly difficult, and so I'm kind of just biding my time. In the interim, where I see opportunity right now is in the pref equity space. So if you're investing in assets where maybe you've got leverage may have went down from 70% from a first position, maybe it's at 60 or 65%, and you don't necessarily want to have 30 or 35% equity in a deal. Well, maybe there's this tranche between 60 and 80% that's coming in as pref equity. It's going to generate a 7 to 8% or 9% coupon and maybe a total return of 14 to 16%. To me, I think, that to me is a slice of the capital stack that I think is compelling right now, because you do have the downside protection of that 20% equity cushion. So prices would have to erode pretty significantly for it to cut into your principal. And at the same time, if things go according to the plan of the developer, redeveloper, owner, operator, sponsor, you should be able to generate those types of returns out of that asset. And so I think my risk profile has shifted over time as well. So from 2011 to really 2022, I was focused on, assets that I would say, the gang-ridden, drug-ridden, beat up assets that were built in the 60s, 70s, and 80s, and going in, renovating them, putting in security, putting in lighting, kicking out the gangs, making it a nice place for people to live again. That business worked really well until it didn't. And, I kind of got caught with my pants down in 22, 23, post-COVID, post the eviction moratorium. I was in Atlanta with 1,800 doors that, I got stuck with. And so looking back, one of the mistakes I made was I was taking more risk than I needed. And so, in reevaluating where I stand today, and maybe I was had a money mindset that wasn't serving me any longer, because I don't need to swing for the fences. My average IRR on the 20 deals I did before 2022 was 27%. It's amazing results.
Right.
I knew it wasn't sustainable. I just didn't know the faucet was going to get turned off in a day.
Right. No, I understand that sometimes it happens to, lost my ass. The time of maximum optimism is when we start piling in even heavier. And, I've seen, there's an old saying that billionaires are created, right, because they roll the dice. So if you look at Elon Musk's history with PayPal, right, then he took all his money, put it into Tesla, Richard Branson, all of them, that's what they do. But, how many billionaires are there in the world, right? But I've seen that. That's what they'll do. They'll $300 million exit, roll it all in, turn it into $900 million, or lose it all and everything. So if you're underwriting deals today and you take a look at real estate, right, and debt, right, because that's the biggest thing. And they're all arguing over variable debt. Are they, do I go agency? Do I go fixed, right? What's your secret sauce there? What, from your experience, what's worked the best for you and what's worked the worst for you? Because everyone that I've interviewed has brought up that subject, right? And all of them have different strategies, and all of them are successful. We all lose every once in a while. There's an old saying, winners know when to take losses. Learn that on Wall Street. Okay.
Well, I like to say not all champions are undefeated. You concentrate to create, you diversify to protect. So, when you see those people that are rolling everything into the next thing, that's because they're looking to create. A lot of what we talk about with the clients that we meet with is this time to diversify to protect, or is there a reason you're going all in? Often, we're dealing with people 8-figure net worth, kind of 7-figure plus income. There really isn't, when you start to identify what does rich beyond money mean to them, whether you have 50 million or 100 million is probably not going to make that much of a difference in your quality of life. It may make a difference in your grandkids' quality of life, but is that worth taking a risk for? Is that worth, or is it just fun? And you want to have fun with it? Great. But then you know what you're going into it for. For me, coming back to the debt, one of the things I loved was high leverage, variable rate financing, 2011 to 2020. It was crack. It was great. I loved it. It generated these incredibly high returns. And I knew that the music would stop. And I thought that, the flaw in my thinking was I thought rates would rise the way they went down and it would take time. And unfortunately we had, the fastest rise of interest rates in history. I didn't really black swan that one out. And it hurt me pretty badly. But as we're looking forward, I would say, creative financing is still a great place to make money in a deal. I think rent growth, which was an assumption that we all felt fairly confident in throughout the whole bull cycle. I don't know how people are modeling their rent growth right now. I think that's an area that's very subject. We've got a lot of pressure on income, we've got a lot of pressure through inflation. And so the question is the rise in insurance, the rise in real estate taxes, the rise in renovation costs, the rise in all of our utility costs and other input costs to running our properties. Well, are we going to be able to capture that through rent growth? Are these people that are renting from us, are they going to have the income growth so that they can pay us the rent that we need? I don't know. And that's really what's got me a bit scared about the market that we're standing in today is I don't know that I could model rent growth with confidence. I don't know that I could model interest rate declines that are going to lead to declining cap rates. I think, it may be possible that we have declining interest rates and a higher spread between cap rates and interest rates. At some point, kind of 2013, 14, 15, when I was buying these C-class assets, we were maybe buying at 400 or 500 basis points of a spread between the interest rate and the in-place cap rate. And nowadays, really in 21, when I sold some assets in 21 and 22, 23 that, I made a killing on, I was selling it at like 110 basis points above the in-place, debt. And I just don't think that's sustainable. The spread needs to expand to account for all the challenges that one has to manage when you're dealing with tenants. It's still a business. You got to get paid to generate those returns.
Right. No, listen, these are very strange times and a lot of uncertainty of what's happening. Like everything you said, inflation, replacement costs. Now we have Doge cutting jobs. Like I'm looking for the new employment numbers, right, or the unemployment numbers. Like, are they going to pull out government, right, and all of these things? So I agree with you, But I also I've learned from my experience, right, is like I'm not always going to win, right? But if I don't jump in the pond, I don't learn how to swim, right? And like this was the joke when I was on Wall Street and when we were buying real estate, right? I did 71 transactions in a period of 6 years. Not everyone was a winner, right? So, but a lot of them were winners, plus a 27% IRR for almost a decade. I mean, come on, right? So the point is what's the entrepreneurial spirit, right? What's the secret sauce, right? And everyone that I know, you know where I'm going. What's the question? How do you keep going when you take a loss and continue with the confidence? Because I've been there. And what separates your success from the others who didn't make it?
Tough question for me to answer because I haven't bought an asset in a year and a half. And for a real estate asset. Now, I've invested in other businesses. I've invested in public markets. So I've invested in other areas where I have more liquidity or more protection or more downside risk protection. I think I will continue to be a real estate investor for the rest of my life. I think real estate's a great asset class. I think for me, it's this recognition of where I want to be on the risk spectrum. And now that I have an operating business, So what's interesting to me is, when I was investing in these higher risk, higher return assets in real estate, I didn't have an operating business. So that was really where most of my risk was coming from. Well, now that I have an operating business, I'm investing more in my operating business. We're testing digital marketing strategies. We're testing social media marketing. I'm making investments in the business because I believe that, while we've failed to date at nailing down how to create, prospects through digital marketing, I want to continue investing because if I crack that code, it's very valuable. And so that enables me to maybe shift my risk to be more conservative in my investments that are taking place outside my operating business. And one of the places I invested, kind of back to your core question of how do you develop a life of freedom as a business owner, is what Gino Wickman wrote about in Rocket Fuel, where you have the visionary integrator pairing. So that was a big investment for me, was hiring my integrator, who's now become my co-founder in WealthThrive and the president of WealthThrive, because she's been with me for 4 years, and she really helped bring the process into the business. She helped to insulate me from all the things that I didn't like dealing with, the employees, the recruiting, the weekly meetings, the KPI reports. She's distilling everything, and she sees it as her job to let me live the life that I want. That is her job. And she really respects that job, values that job, and takes it seriously. And she knows how valuable it is to me to know that I could rely on her to filter everything so that before it gets to me, she knows that, I want to see this because of how important it is to the future of the company, and that my talent and my experience is going to provide value to the situation, not just another voice in the room.
I want to take a quick break to ask, did you enjoy the video so far? If you want to learn how real estate titans make millions, hit that subscribe button now. Join us on Real Estate Profit Boost with Jerry Katz at Jerry Katz CEO for expert tips and insider strategies to grow your wealth.
Right. No, excellent. No, I've been down that road. I know. But what I hear in you is still that entrepreneurial problem-solving spirit, right? You're like, I'm going to master this digital marketing. I'm going to figure out how to, get other people rich beyond money, right? Because that's technically the most unique. I mean, listen, that's not true, because you've given me tax strategies over as long as I've known you that blew my mind away. Your seed funds and the dirty dozen and all those kind of things. You've made me look at the IRS in a different word, right? Where I was scared to death, like stress of the IRS. What if something happens? I'm audited. I gotta look under my skirt. Am I keeping my records, right? But no, I realized that when you have a guy like Noah who's sophisticated, understands their processes, just like he's figuring out digital marketing on WealthThrive, he understands the systems and processes of the IRS, the audits, and everything. And it changes the game. So now when you have somebody like him on your team, your anxiety levels come down, which allow you or me or any other entrepreneur or any beginner out there to focus on what they're good at, right? And for someone to have mastered, I'll give you a quick example, right? I got, and this is going to be a little funny, I have my cable went down at my house from Comcast, right? Typical, right? So my wife calls, no one's at the house, kids are at school, and they call and they said, yeah, we'll be there from 9 to 12. Okay, and I'm like, yeah, sure. Right? So I go, you know what? No way. I call customer service. I go, yeah, hi, Mr. Katz, blah, 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 the address. Yeah. What time? I'm 9 to 12. Okay. So where does the truck come from? She says, oh, we have a dispatch center in Broward County. And I go, okay, the dispatch center. And what time do they get there? 7 a.m. And what is it? Schedule? Yeah, they use a computer. Everyone knows where they're going by 8 o'clock. All right, so who's in charge of that? The dispatch manager. Do you have their phone number? She goes, I technically do. I have her phone number. Perfect. So if I call the dispatch manager, right? No, well, you're not supposed to. But, here's the number. Do you have their name? Yeah. Mr. Schwartz, whatever it was, right? Mr. Smith. Okay. I hang up. I call the dispatch manager. But first, I went on LinkedIn. I looked at the C-level people in Broward County Comcast, right, at management level on their websites. I go, hey, Mr. Schwartz, he was the district dispatcher. And I said, listen, my name's Jerry. I'm friends with this manager, blah, 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 blah. They gave me your phone number. And Mr. Katz, it's okay. We already have you on a truck. Your driver's name is Steven. Here's his phone number. Feel free to call him right now to find out exactly, because you're 2 on the list. Bam. I called him. He goes, oh, it was like 9:30 a.m., same day. He goes, oh, I just finished my call. I'll be there in 15 minutes. I'm 9 blocks away. So, okay, so that's the point, right? Because I'm not going to sit there and say 9 to 12. So why am I bringing this up? This gentleman, Noah, understands the tax code in that way, right? Where my point is, the stuff that he has told me and the experience that I've got, I'm like, what? Like, I could never get to that level of education unless I did what he did full time, 3rd generation CPA, all of his experiences. He understands the systems and processes, and he operates from rich beyond money, right? So core values and structure. So when you have somebody on your team like that, he's going to do, and his team, what I did with Comcast to make sure that I knew in 15 minutes exactly. The difference is, most of people, they're stuck in the status quo. They're stuck listening to their CPA that says, no, that could be an audit risk. Well, really? Did they know the internal processes? This guy does. So that's my biggest takeaway kind of today, right? From everything that you said and so on and so forth. And the key for Real Estate Profit Boost is to give away your secrets, right? And you did. You mentioned many, many, many tax strategies. So a couple more questions. By the way, one more time, Noah, how do people reach out to you? Who's your ideal client, right? Because that's important. Noah's not always working with everyone and so on. So just repeat that, and we'll go into a few more questions and then have some fun.
Yeah, we work with entrepreneurs that have 7-figure taxable incomes, or maybe they have an 8-figure exit that they're planning. Maybe you're selling a big asset. You're not going to do a 1031. You want to understand what your alternatives are. Actually, I got a call later today, right after this interview, with a guy who's selling 2 assets. He doesn't want to do a 1031. We'll show him a strategy that he could defer his tax for 16 years with another structure, and then potentially eliminate that tax through a step up in basis through a creative trust structure that we have. So if you're facing one of those problems, you could go to talkabouttax.com and fill out a short form, and that'll give you access to the calendar from my team. And yeah, we love
That's
helping
strong.
people with problems.
Talkabouttax.com. Okay, go ahead. So
Yeah.
what I heard is, don't just sell a property. Don't just sell your business. That probably would be the biggest mistake before you
Yes.
go to call a person like Noah, correct? And that's
Yeah, I like to say, you want to, if you know in advance, the best time is a tax year before. And the reason why a tax year before is helpful is that sometimes we're going to restructure your entities, and that way you get, 2025 tax returns and then a 2026 sale. Now, if you come to me in 2025 and you're selling in 2025, we still have strategies for that too. If you come to me in 2025 and you say you sold your business already or you sold your asset already, I got strategies for that too. But the longer notice you give us, kind of 18 months or more, 18 months is kind of the sweet spot, we'll be able to help you.
Right. And I'll tell you another thing that Noah told me before. You can actually go back and change your tax return from 3-4 years ago, right? Like, say you had a big capital gain or you sold a business and you actually wrote a huge check. Noah told me you can go back. Give us a small story on that, Noah.
Yeah, so there's one, well, I'll give you 2 stories. So one was someone in my EO forum, Joel Gandera. So you know, Jerry knows him. Maybe some of your listeners might know him too. He runs a great men's program. And so Joel came to me when he owned his business, and he had acquired 17 companies. And when I looked at his tax return, I was surprised that I didn't see depreciation on the assets that he had acquired. So when I asked him about that, he goes, I don't know, let me ask my tax preparer. Well, he went to his tax preparer and said, oh, yeah, I guess I could have depreciated those acquisitions. I just didn't do it, So it ends up that you could go back for 3 tax years and amend your tax returns. He was able to go back. He got a $250,000 refund check. I got a nice big hug and kiss. And
$250,000.
$250,000 in his pocket. That's the good news. The bad news is there was another $450,000 that he would have gotten back if he had filed them properly to begin with. He just couldn't go back beyond those years. Now, another case, I had a guy come to me in 2023. He sold his company for 20 million bucks. He lived in California. He had to pay about 7 million in taxes on that sale. And so he had actually written the check before he met me. And then I showed him a strategy where he could buy solar installations, and the solar tax credits were greater than the equity check that he had to write for the solar install. And as a result, we were able to get him $1.5 million of credit in excess of what his equity check was. And he was able to put that back and apply it to the previous year and get his $1.5 million refund.
Right. So not only are we, the audience is listening on forward things or exits. No, if in the last 36 months really is the sweet spot, or maybe even longer, it doesn't hurt to reach out and ask, right? And you're saying, oh my God, I paid this tax. That's why it pays to work with somebody like Noah, someone who's sophisticated, someone who shares good values, purpose, and puts it out there, so on. Okay, so now here's one for our younger viewers, right? They want to get started in real estate. It is called Real Estate Profit Boost. Going back to your younger self on that deal that, you left, he house hacked, he walked with $40 from his first closing. I have a video on this channel that says how to buy with a real estate with zero down, and I get questioned. They don't believe it. My staff, right? Because everyone here at the office, my goal is for all of them to own real estate, and a lot of them do. But they're like, where's the down payment? So going back to your 21, 22, what's something you could teach that younger audience that they can implement today on actually buying a piece of real estate?
So I think the one thing that people don't often think about when they're 21 or 22 is other people's money. They think most often that they've got to do it with their own capital. And the reality is that there's probably people in your sphere of influence. If you're a young hustler, people know it. Your friends' parents know it. Your aunts and uncles know it. They know that you're out there because you want to make a buck, and you're going to hustle and grind until it happens. And so what you want to do is leverage that reputation to attract capital into a transaction. And for me, I didn't do this for the first 10 years of my real estate investing career. I only relied on my own capital. And in hindsight, I would have been able to accelerate my success if I recognized at 23 years old when I was buying that first house that I didn't need to buy a $225,000 two-family home. I probably, even at that point as a youngster, because I was a young hustler, because people knew I was a go-getter, I could have raised $300,000 and bought $1 million commercial property down the street and started at a bigger level. So I think, evaluate whether or not that's a business model for you. Using other people's money is a way to accelerate your success and the rewards of your success. And it's a joy that I found in helping other people make money on their money. It's a joy that I found in showing them the power of real estate investing. It's a joy in creating a relationship with someone where they're relying on you to help them live the life that they want. And so I would encourage you to consider whether or not that could be a path forward for you.
No, very interesting, right? And I have a similar story, but I should have went further with it. Meaning, if I go back to, when I first came down to Florida, same thing. I bought my first, Fourplex with $15,000 that I had, and then $10,000 on a credit card, and used a hard lender. But after I had one or two things on my belt, I had a reputation under my belt, a little reputation. And a couple of my family members asked me, hey, I'll give you money if you want to pay me 7% or 6% back then. And I did take some, right, from my father, and then my father's friend asked if he could do it and stuff. But I always was afraid if I screwed up, right, and I shouldn't have been, because I had a very successful run, right, where we had, 60 winners and 2 losers, which is okay, right? And that's another big learning point. It's okay to have a couple losers. Your biggest loss, I found, was not doing anything. Analysis is paralysis. And the last comment I'll make is what I see in Noah, which I see in a lot of people that we interview, is, first of all, it's the hustle, right? It's the execution. So many people have ideas, right? But and people are even afraid to share ideas, right? And I'm keeping it a secret. That was me at one point, right? But what I learned is the same day that Noah came up with Wealth Thrive, right? To rich beyond money. So did 3,000 other people around the world. And here's what happened. 3 people tried it. One stopped halfway and said, nah, I can't do this. This other person failed, and then there was Noah. But do you see that in this world?
I see it all the time. Yeah,
see it all
I
the
think,
time.
ideas have value, but execution is where value is created.
Exactly. And by the way,
That nothing comes to life from an idea. It all comes to life through execution. And for me, again, kind of back to that pairing of the visionary and the implementer, I think you've got to have someone who could take your ideas and execute on them. Often the best idea people are poor execution people, and the best execution people are poor idea people. And that's not a knock on either one of them. It's that the reason you need this powerful combination.
Right. And I've been down that path too at a Gary Vaynerchuk EO in Philadelphia, where he looked at me in the audience and he says, stop trying to fix what you're not good at, right? And turn around and do whatever you're good at 1,000 more times. And I started laughing. And he's like, why? Are you laughing? You're a big-headed Russian guy. You're laughing in the front row. This is Gary Vaynerchuk 10 years ago, right, at an EO convention in Philly. And he goes, why are you laughing at me? And I go, because we're at a self-improvement conference, okay? I'm trying to fix everything that I'm not good at. And he goes, listen, whatever you're good at. And that's what Noah's referring to, right? And I have an integrator, right? Noah's way more organized than I am. He's more, I would say smarter, meaning, what's your formula? It's happiness times wealth, or what is it?
Equals prosperity. Right.
Right. Say it one more time.
Prosperity equals wealth times happiness.
Prosperity equals wealth times happiness. Right. So look he's disrupting the tax world. Okay. He's been doing that for a couple decades. He's got 5, 6, 7, 8 books. I don't even know his bio's so big. He's got 50 real estate deals, 900 this. He had a family office once that focused around divorced women, right, at one point, and then so forth. So he's way out front, and he's creating his own legacy, right? It's not just assets minus liability, equals profits or whatever. It's wealth beyond, right? I keep saying it wrong. It's wealth beyond money. And he's got a formula for that too. So, all right, Noah, I want to thank you, brother. He's one of my brothers, real estate brothers, for coming on. Awesome. Again,
with pleasure,
tell them.
Gary.
Yeah, you're the man. Tell them where to find you.
Connect on social media. I'm now on Instagram, so you could find me on Instagram. You could find me on Facebook, LinkedIn. I think sooner or later you'll see me in other places. Talk about tax if you want to talk about your individual situation and you're making $1 million or more. And put out resources all the time online. So if you connect with me online, you'll find a bunch of free resources as well.
Google him, pick up his book, but talkaboutax.com. I love it. I'm the same way. If you want to find me, I'm Jerry Katz, CEO, all over the web. Him and I are newer in this game, but watch us scale. But that's Real Estate Profit Boost. A lot of good things happened here today, a lot of strategies, a lot of value. Do us a favor. Comment below. If you see something that we didn't see, this is a community for learning and growing from each other. You're an investor, you're a CPA, you're an attorney, whatever you are, give us some feedback and share and be a part of the community and share it with your friends who also need this. It's all about giving back. That's our happiness. He gets it, I get it, and we're going to teach it to you. So that's it for Real Estate Profit Boost. Boom, we're out. Peace, love. Thanks for everybody. Boom. That's Real Estate Profit Boost with Jerry Katz CEO all over the web. We created this community right here to help you scale in the world of commercial real estate. It doesn't matter if you're a beginner or if you're a seasoned syndicator or an institution. We will be interviewing the titans of real estate right here that share all their successes, their strategies, their execution, more importantly, and their biggest failures. Why? So you don't have to. So what you need to do is subscribe below. Share this with a friend, comment, and let's create a community of learning and growing from the biggest titans in real estate right here on Real Estate Profit Boost.